In today's video, we're going to be going over the different loan types that a buyer would use when purchasing a home. Hello again, it's Chris Valley with RE/MAX Center, and I have Lee Blodgett with North Point Mortgage here. And we just did a video where we talked about closing costs when a buyer purchases a home and how the different loan types can affect what closing costs go into that. But we wanted to do a deeper dive video where we talked about actual loan types and what they are and what the benefits are to them, what the differences are in them. The first loan type that I mainly see out there is the FHA mortgage. So what is the FHA mortgage? What are the benefits? What are the differences? What can you tell us about an FHA mortgage?
Yeah, absolutely. So the FHA loan is it's the Federal Housing Administration. It's a government-backed mortgage. It's really popular with first-time home buyers. The main points about that loan, and you'll hear about it, as a first-time home buyer, is it allows for a low down payment, as little as 3.5% of the sales price is your down payment, which is good for first-time home buyers. It's not sensitive to credit score as far as the interest rate goes. So for maybe someone that's first establishing their credit or reestablishing credit, the interest rate's very low, even if your credit score is not so high. And then it is, because it is set up for first-time home buyers and folks maybe getting established, it's pretty liberal on some of the rules and guidelines as far as getting people into houses and the way that we get the approval done. So it's a really popular loan as far as that goes, and so you'll see it pretty common in the first-time home buyer. There are some limitations to it. We all loans that someone's putting less than 20% down on the house is going to have something called mortgage insurance.
There we go.
And you've heard that term or you've seen it on the internet or whatever, but mortgage insurance can take different names, and so you kind of have to identify it, and we'll kind of talk about it on these different programs. But the gist of it is, if you're putting less than 20% down on a house, you have to have some type of mortgage insurance, and it's called a mortgage insurance premium with FHA, and they actually charge something on the added onto the loan is an upfront cost, and we talked about that I think a little bit in our last video. And then there's a monthly mortgage insurance expense, and so there are other loan programs that could possibly, depending on credit score, be a better option for folks, and that's part of what we do when we go through the process, is talk about that with them.
Yes, that was an awesome explanation of the FHA loan type. So the next main one that I see on most of the deals that I do throughout the year will be the conventional loan type. So what can you tell us as far as what the conventional loan is, how it maybe is a little different than FHA or other loan types, what are the benefits of it, those type of things as well?
Absolutely, yeah. So the conventional loan is probably the most popular as far as done. If you've heard the names Fannie Mae or Freddie Mac, when you hear about a conventional loan, they're really backed by those two entities as far as the type of loan. And a conventional loan, kind of compared to that FHA, the conventional loan is a little more sensitive to the credit score that someone has, but there are some benefits if you're in that higher credit score tier. The other thing is it usually requires 5% or more down as opposed to that 3.5% on the FHA. Unless, of course, you're a first-time home buyer, then they do have some programs that allow as little as 3% on the conventional loan. But if you're going to compare it to the other loans or to the FHA loan, the big advantage, like I said, is if you're in a higher credit score position, we start talking about the fact that the mortgage insurance that we were talking about on the other loan in the FHA has some upfront and some monthly. Well, the monthly can be much cheaper, as much as half of what it is on the FHA loan if you're on that higher credit score, and there is no upfront mortgage insurance. And then one of the things I didn't really mention on the other one is that mortgage insurance on the FHA loan doesn't typically fall off of that mortgage ever, even when you get to an equity position. Or even if you put 20% down, there's always going to be some mortgage insurance on that loan.
Whereas,
exactly, the benefit to the conventional loan is if you put 20% down on the conventional loan, there is no mortgage insurance. And then again, if you put less than 20% down, it's tiered based on credit score and can be very low relative to like an FHA mortgage.
And then once they get to the 20% down, they can contact the lending institution and have the mortgage insurance removed?
Correct, yep, actually, yes.
Do they have to do a reappraisal?
No, so there's two ways to do it. So it's a great question. So if someone puts 5% down, it's possible through the appreciation of the house that they could petition the mortgage company to have it removed because they have enough equity. But there's actually a law in place that says once they've gotten to 78% of what they originally purchased the house for, it by law has to fall off of there.
By law, well, there we go. So again, great explanation on those two loan types. There's another loan type though that I do see, And I feel like it's for our braver Americans, or our bravest Americans that we have out there, and that is our VA loan, and that is a Veterans Administration loan. And what can you tell us about the VA loan and what the advantages are to it, what the differences are to it, that type of thing?
Yeah, absolutely. So, yeah, as you mentioned, it's for our veterans, it's a very important loan for all of us. Make sure we take really good care of our veterans, and it does have some great benefits. It is a government-insured loan, similar to the FHA loan, but like you said, it's solely for veterans. The real huge benefit to the VA loan is they'll actually do 100% loan, so zero down payment for our veterans. There is a type, and as I mentioned before, there are different names to the mortgage insurance. With VA loans, they use the term funding fee.
Funding fee, yeah.
Yeah, so they don't have monthly mortgage insurance, but they have a funding fee depending on if you've ever used your certificate of eligibility or your VA before, and then if you've used it again, it's a little bit higher, and that's an amount of money that gets added onto the loan and financed over 30 years.
Okay.
But it is a cost associated with that loan. So if you're putting 20% down, then you might still look at that conventional loan. But the huge benefit to the VA is that you zero down. Even when you add in that funding fee, the monthly payment is still relatively low because there's no monthly
mortgage insurance.
There's no monthly cost to it, so it's really economically a great loan. There are some limitations. There's some extra steps. They require a termite inspection, which isn't really required on other loans.
Right.
A little bit more detailed appraisal inspection because they're really trying to protect the veteran and make sure that everything is, in good standing with the house, in good condition.
Yeah.
So their appraisal process goes more into like a home inspection than maybe some of the other loans do. But so like I said, small limitations, but it really is a great loan.
But again, I think you said it earlier. Does a veteran have to use the VA loan, or can they use another loan type if it's more beneficial? What is the answer to that?
Yeah, so you definitely don't have to use the VA, and there are reasons that you may not want to. So we'll compare the VA to one of the other options like an FHA or a conventional to see what makes the most sense.
And you would do that while you're working with the person.
That's part of our
case by case
consultation
basis
to determine exactly right. Yep. So there are benefits to. Like the example I said with the 20% down, if you're putting 20% down, then the VA doesn't make as much sense maybe as a conventional loan if the credit score is really high. But again, if the credit score is lower, then that VA may make good sense in that situation. So it will be case by case.
So you run the different scenarios, look at the math, explain it to the client, and let them make the best educated decision on that.
Yeah, that's how we look at it.
All right, so another loan type that I get asked about a lot, and there's a little bit of confusion, I feel like, that out there with buyers on this one, is the USDA loan. So could you explain what the USDA loan is, why buyers seek it, and or some of the general qualifications for the buyer and for the property in order to be able to get a USDA loan?
Yeah, so the USDA loan is, it's a good loan economically speaking, because it allows for no money down, actually 100% loan.
So like the VA loan, it's 0% down.
Like the VA loan,
and that's why people probably love it, want to try to get a hold of it.
100% reason why, yeah. And they, you don't have to be a veteran to qualify for it. It's, it's open, and we'll get into kind of the limitations. But the economic part of it that's so good is exactly what you said. It's no money down. And then again, back to the different terminology of mortgage insurance, but essentially being mortgage insurance, is they call their mortgage insurance a guarantee fee.
Okay.
So there's an upfront guarantee fee, but it's smaller than relative to an FHA loan's upfront mortgage insurance. It's actually lower there. And then it actually has lower monthly mortgage insurance than the FHA loan. So comparatively speaking,
it's still better.
It could be better overall payment and economically speaking relative to an FHA loan at 3.5% down, at 0% on the USDA. And so for that reason, in and of itself, that's what's so great about it economically speaking. The limitations are...
How does somebody get a USDA loan?
It's a good question, and that's where it gets a little tricky. So the limitations are, one, it is a rural housing loan, so you have to look up and see if the property is considered to be outside of a metro area, and so the property itself has to be eligible.
Yeah, and I'm going to give you further information in a second on how to do that, but go ahead.
And then there's also income limitations to it, so they want it to be an affordable housing type loan. So if your household income is too high, if you will, then they could be limited on qualifying for that mortgage. And they do look at your entire household, not just the person qualifying for the loan, which is different than what we do on all the other loans. And then lastly, one of the limitations is USDA has to approve the loan. So your lender that you go to and get approved for the mortgage may have fully approved you, but actually at the end of the process, they have to send that to the USDA
right,
to review it and approve it before you close. And so that's kind of an extra step.
It's going through an extra step, extra layer of approvals. So not just you guys approve it, y'all put the package together. You have to still send it over to the USDA, and then if they see anything wrong with it, they'll send it back to you and say, hey, this needs to be corrected and that kind of thing. And then once both you guys and USDA's looked at it and signed off on it, then it can finally head to a closing.
Yep, exactly.
Awesome. Okay, so I'm gonna tell you guys more about what he was just mentioning about the USDA and how to go look up what he was just describing. So you're gonna wanna go to the USDA website, which is usda.gov. And when you get on there, you're gonna click on single family direct home loans, then click on property and income eligibility, and then click on what state you're purchasing in, which I'm hoping would be Georgia. And then type in the address for the home that you are looking that's for sale, and it will let you know if that home is in a USDA approved area, and then it will also go through the exact income requirements. It probably lists how much a year the household income needs to be and those type of things.
It
is
does.
there anything you want to say on that?
It does, and you can prompt that, but there are unique ways in which they calculate and determine income.
Okay.
So you definitely want to talk to a lender as far as how the income's calculated, but it will give you a general idea of what that is and tell you what that limit is. Yes.
Okay. So you want to talk to a lender, and in case you're having trouble finding one, there happens to be one right here on this video.
There you go.
So we'll have Lee's information at the end of this video. So that was USDA loans, and then there's one more loan type, and I feel like it's starting to come up more and more frequently now due to the rising home prices, and it's one that you handle as well, which is jumbo loans.
Yeah, jumbo loans. Yep. So
what can you tell us about jumbo loans? What is the difference in that and these other type of loans? Why would somebody use one or not use one? That type of thing.
Yeah, so it's a great question. So really, the one important thing to talk about when it comes to the FHA loan, the conventional loan, the VA loan, or the USDA loan, all those loans, no matter which lender you're going to, the rules of those loans are governed by the Federal Housing Administration or Fannie Mae or those folks.
It's not rules you're coming up with and then another lender has different rules. You're all supposed to be going by the government regulations, right?
Exactly right. And so there may be banks or lenders that put in extra rules, but for the most part, exactly what you just said is we're really following the same rules. So you just want to make sure you're talking to a professional that understands those rules, but the rules are the same. Jumbo loans are almost the complete opposite because the jumbo loans, what happens is in all of those previous loans, there's maximum loan amounts that someone can borrow. The conventional and VA are the highest at like $548,250 is the loan amount. Okay, so as you're trying to borrow more above that is where a jumbo loan comes in. And
so if you're buying a $600,000 or $700,000 house and then you're putting a certain amount down, the highest amount you can get with the other loan types is around $548,250. Yeah. So once the borrow amount goes above that, they almost pretty much either have to put more money down or to get under that, or they need to go with a jumbo loan.
Correct statement.
And then how much do they need to put down to do a jumbo loan though?
So on a jumbo loan, you have to have 20% down. So there are cases where there could be less than that, and the rules are constantly changing because of what I just said, and the fact that individual lenders make the decision on how they want to loan on jumbo loans as opposed to the rules that are set by the governing things like FHA and VA. And so there have been times where there's been as little as 5% down on jumbo loans, but right now coming out of COVID, most jumbo lenders require at least 20% down.
20%.
So if you're talking about $1 million home, the benefit to a jumbo loan is you can put $200,000 down and have an $800,000 loan as opposed to having to put almost $500,000 down to get down to the maximum.
To get down to the conventional loan.
Yep. So that's the key to those loans.
And then is there a difference in what the interest rate is on a jumbo loan or?
Yeah. So the interest rate's a great question actually on all of them. Is the interest rate can vary from loan to loan. So it's one of the things that we look at when we're trying to fit someone in the best loan program is what that interest rate is at that time. There are times where there's a large disparity between the jumbo rate and maybe a conventional loan, and sometimes they're very close to each other, and sometimes the jumbo's better. And, right now we're seeing jumbo loan rates a little bit higher than conventional. Same thing coming out of COVID. Those loans are a little different because they're individually priced and based by individual lenders.
So maybe a little bit higher of a rate, but again, theoretically less money down to get to that larger purchase
Exactly
price.
right. In our example of $1 million house,
Right.
if you're taking
Easy math.
$300,000 extra out of an investment vehicle to get down to the 548, that money may have been earning,
It was higher
10%
right,
in a market.
right,
Exactly right. Yeah. So there's some benefit, definitely some benefits to the jumbo loan.
Lee, that was amazing, like descriptions of all those main loan types. And like you were saying earlier, there's a lot of decision making going on. There's a lot of differences, and basically they need to get with somebody like you, if not you, somebody that's very versed in the lending world, to be able to explain what would be like an educated decision on which loan type would benefit with their personal financial situation when purchasing a home, right?
Exactly. It's definitely a case-by-case basis.
We hope you enjoyed this video on loan types. Lee and I also did a video on closing costs where we went more in depth on what closing costs are involved when you do purchase a home. As always, we want you to comment below with what you think of our videos, and be sure to like and subscribe so that you can get more real estate videos like this from the Valley team.